Welcome to this explainer. You know, there is absolutely nothing quite like the siren song of a massive double-digit dividend yield to catch an investor's eye. Today, we're putting America's largest mortgage REIT, AGNC, through an analytical trial by fire. We are going to strip away all the noise and just look strictly at the numbers to see what's actually going on beneath the surface.
Okay, let's just dive right in. A stock flashing an unbelievable 13.3% dividend yield. I mean, in a world where your standard savings account or a typical bond might get you 4 or 5% on a really good day, seeing a double-digit yield like this immediately grabs your attention. It's the exact kind of number that makes seasoned investors simultaneously incredibly excited and, well, deeply suspicious. Because yields that high almost never exist without some serious underlying risk attached to the whole shebang.
And get this, it pairs that massive yield with a shockingly cheap price-to-earnings ratio of just 5.5 times earnings. So basically, you're paying just $5.50 for every single dollar of profit the company makes. When you compare that to the broader market average, which is usually hanging around 20 to 25 times earnings, it looks practically free. It's effectively trading at a 75 to 80% discount to the broader market. So, the million-dollar question we really have to ask is this the ultimate high-yield value play, or is it a dangerous dividend trap heavily disguised by some really shiny numbers? That is exactly what we're going to figure out today by weighing both the bull and bear cases.
Here's our roadmap for today's explainer. First, the shiny object. Second, decoding red flags. Third, the green flag rebuttal. Fourth, a Titans face-off. Fifth, the moat debate. And finally, our final verdict.
Section 1. The shiny object. Let's quickly look at AGNC's business model and how they actually make their money, because understanding this specific mechanic is pretty much key to everything else we're going to talk about today. AGNC is an MREIT, or a mortgage real estate investment trust. This means their entire $97 billion business model relies on borrowing short to buy long. To break that down simply, they borrow money at low short-term interest rates, and they use that cash to buy long-term mortgages that pay a higher interest rate. Their profit is literally just the spread, the difference between the two. And they manage to do this while leaning heavily on government guarantees from agencies like Fannie Mae and Freddie Mac to mitigate their credit risk. Section 2. Decoding the red flags. We need to expose the hidden risks here. Because while a 19.8% return on equity and a massive 15 to 16% stock rally over the past year sounds absolutely incredible, there is a massive underlying risk that the media is largely ignoring. Check out their current ratio. For every dollar of current liabilities they owe, they hold just 19 cents in current assets. 19 cents! That is a glaring liquidity crisis for any traditional investor looking for a margin of safety. To put that into perspective for you, Benjamin Graham's classic value investing framework requires a current ratio above 2.0. AGNC's is sitting at 0.19.
And then, well, we have the absolute elephant in the room. 717% debt to equity. This means they're using 7.17 times leverage to generate those juicy returns. For every $1 of equity, they have over $7 of debt. The danger here is that leverage acts as a massive multiplier, right? If property values dip or interest rates swing the wrong way, that leverage multiplies their losses instantly, which can be deadly during a financial crisis.
But beyond the extreme leverage, we've got a whole avalanche of hidden risks to unpack. They have negative free cash flow, meaning cash is literally leaving the business faster than it comes in. They have a 112% dividend payout ratio. That just means they're paying out more money to shareholders than they actually earn, which puts that massive dividend at a really high risk of a cut. Plus, there's a 9.12% short interest from investors who are actively betting against the stock. And maybe most terrifying, they have a 22.4% annual share dilution. They are creating new shares out of thin air, making your existing shares significantly less valuable over time.
So it's honestly no wonder Wall Street is getting nervous. Multiple major analyst firms slash their price targets right after Q2 earnings. We see Compass Point dropping their target from $12.50 down to $11.50. And major banks like Bank of America, Wells Fargo, and JP Morgan, they're all following suit, lowering their targets to $10.50 and $11. Section 3. The green flag rebuttal. Let's switch gears and look at the bull case. We absolutely have to look at both sides impartially, because the bullish argument for AGNC is undeniably compelling. There's a very real reason this stock is so incredibly popular among income seekers.
Since its IPO in 2008, AGNC has paid out over $16.3 billion, or $50.80 per share. That proves 17 straight years of reliable monthly cash distribution. Think about that. Through multiple market crashes and crazy interest rate cycles, that kind of track record is really hard to ignore. And the management team is actually executing well with consecutive earnings beats in Q1 and Q2. They delivered a 9.9% year-over-year bump in tangible book value, meaning the actual hard assets of the company are steadily growing. Plus, they possess a massive $97 billion portfolio scale. That immense scale grants them incredibly cheap financing, resulting in a weighted average cost of capital, or WACC, of just 1.43%. It costs them almost nothing to borrow the money they use to buy mortgages. When your entire business is capturing the spread, borrowing that cheaply is a real game changer. Section 4, the Investing Titans face-off. The shiny metrics are definitely pulling us in, but that leverage is terrifying. Let's run this through the gauntlet and see how 3 investing titans would hypothetically evaluate the stock based on their famous frameworks. Well, when put to the ultimate test, spoiler alert, all 3 legends reject it. Benjamin Graham fails it for the liquidity disaster of that 0.19 current ratio and the excessive leverage. Peter Lynch fails it for the massive share dilution and negative free cash flow. And Warren Buffett? He fails it due to the extreme leverage masking a total lack of a true competitive moat. You can practically hear the conclusion under Peter Lynch's framework. Negative free cash flow, massive dilution, extreme leverage. This is the opposite of what I look for. I'm out. When a company is burning cash and printing new shares, it completely destroys the core logic of investing, no matter how juicy that monthly yield looks. If you dilute the outstanding shares by 22% in a single year, you're fundamentally eroding the ownership value of existing shareholders just to keep those payouts going. Section 5, the moat debate, scale versus leverage. This brings us right to the linchpin of Buffett's hypothetical rejection. Does AGNC actually have a durable competitive advantage, a moat? While their $97 billion scale and ultra-low borrowing costs provide a thin structural advantage, it's pretty much instantly compromised by their total lack of pricing power and absolute vulnerability to shifting interest rates. They are entirely dependent on macroeconomic forces completely outside of their control. Section 6, the final verdict, trap or treasure. So where does this analytical teardown leave us regarding America's largest MRIT? How in the world do we balance the incredible historical dividend payouts against those glaring red flags of dilution and leverage? Ultimately, AGNC is just not a value investment for the faint of heart. Rather, it is a high-yield income tool where investors are being actively compensated for taking on immense leverage risk. If you're a classic investor looking for safety and predictable organic growth, the metrics we've gone over today simply don't align with those philosophies. If you are considering entering this arena, it is absolutely crucial that we cover all points and you keep your eyes peeled for a few critical dates. The next ex-dividend date for their 12-cent per share monthly payout is July 31st, 2026. But more importantly, pay close attention to their next earnings call expected on October 19th, 2026, to see exactly how they address that dangerous 112% payout ratio. You really want to see if their leverage metrics show any signs of cooling down. I'll leave you with this final, critical thought to ponder as we wrap up this explainer. Is chasing that mouth-watering 13.3% yield truly worth risking your principal on 7.17 times leverage? It's a huge question. The numbers are all out on the table now, but the final decision, as always, is up to you.